Hello, everyone. Happy Saturday. I hope you're having a fantastic weekend, and welcome to another Saturday stream. I'm so happy to be here with you guys, and really happy to talk about investing during a recession. Why would you even think about doing something like this, right? It just seems so counterintuitive. Why would you want to invest when things are not looking good out there, right? You want to invest in optimism when people are happy, right? No, actually, that's not really what you want to look for. The most successful investors on the planet know how to diversify themselves and keep them safe to be able to invest in any type of economy. So that's what we're going to be talking about here today in just a little bit. So again, a lot of investing is about emotional relationships with your money and with your free time and all of that. And so being in a market where things ebb and flow is very emotional. And so the most successful investors in the world, such as Warren Buffett, has complete control and a plan to be able to handle how they're going to feel and how they're going to manage their assets as they're working through the different stages of an economy. Because every economy tends to go down over time, and it has to do with a lot of the debt cycle dynamics that actually we're going to be touching into a little bit later on in the stream. But again, main point is that investing is emotional. If you have control of your emotions, and as Warren Buffett says, he says, I believe the quote is, you should invest when, be fearful when others are greedy, and then greedy when others are fearful. And I think that may help, from a stock point of view, help you understand that if people are fearful, then prices are low. And so you can go swoop in there and pick up stocks for really low price, and then it goes up, and then you sell those, and you kind of use that to your advantage. And while that is true, there is a lot to be said about that type of mentality, because even though many investors tend to actually play that way and they tend to go in and do that, it's very hard to actually execute on that plan, because as you're going through the emotions, you kind of want to ride the cycle of the market as it goes. And you kind of, the more media that you listen to, the more you start to get kind of veering off of your own plan, and you start to make changes. And then that kind of destroys pretty much all of the planning that you had put in place to try to get it going, right? So really the best thing to do is to work with the emotions and get that going. So that was the first main point that I wanted to talk about. Everything in a recession is on sale. So if you're prepared for it, then this is the perfect time to buy anything, real estate, stocks, any types of assets. So I would encourage you to think about where we are right now in the cycle and where you think we are and what's going to happen in the future. I can't give you a crystal ball, and I'm not trying to give you guys financial or investing advice here. I'm just trying to show you what I'm seeing and teaching you as an educational, it's sort of like an educational center here. But just know that things go up and down with time. And if you can be prepared for when the sales come, kind of like when Black Friday comes every year. Every year, you know it's going to be there in November. So the really smart, savvy shoppers are the ones that maybe save up their cash for that time of year, and they're able to execute and put a plan together to do all their gifting. I mean, what if you could buy all of your, Christmas, Hanukkah, holiday gifts during Black Friday, right? And then gift them out. That you'd save a lot of money that way, rather than not having a plan and just buying stuff for yourself, and then not having enough money when Christmas or Hanukkah time comes around, and you end up needing the money, but everything is the prices are high and you have to get things online. And then this year we had this online restriction. People couldn't get stuff sent to their house. So having a plan in general will just help you get there, right? So that's one of the most important things, and the theme that I'm going to be kind of weaving into all of this discussion here today. You're also going to learn a lot about cycles, because markets ebb and flow. And so it's important for you to understand that too. Okay, so the first thing that I want to do is I want to go a little bit deeper into emotion. We spent a lot of time talking about that a couple of minutes ago. And so I found something that was really cool that helped explain, how this all works. So what I'm going to do is I'm going to show you guys this little graphic that I picked up. So here you should see the cycle of market emotions. And as you can tell up here, obviously things are going good. Home prices are up, stock prices are up, everything is doing fantastic. And this is a traditional market cycle, right? These are the types of emotion that you or your family or people around you might feel. as we're going through this market cycle, right? You see, you have thrill, euphoria have been going on great for such a long time. And then all of a sudden things start to drop off, and then anxiety starts to come in, right? And then you start getting denial. And then as things really start going down, you start losing your 401k, and things don't look good at all. Then you start getting to a point of desperation, panic, and then eventually just apathy. Just kind of give up and start getting, a little bit depressed down here. And then, of course, everything changes again. Market winds change and things start picking up again. And then you kind of go through the whole cycle all over again. So those who are disciplined enough to understand and see this cycle of emotion and be able to step outside of the emotions, and instead of going with the emotions, but using the market emotions to help you execute an overall plan. For instance, saving when times are good right here, and maybe not risking all of your money or assets in risky things that go up and down quickly, right? And trying to time the market, right? Trying to sell here and then buy here. We never really know where the up and where the down is. And so it's really risky to try to do something like that. So instead, we always recommend that you diversify yourself and get yourself into a position where you're always building a little bit, no matter what the financial situation is, so that you can be flexible. If something does happen over here in the peak or in the trough, then you should be able to adjust to that, right? And if you find an opportunity that you absolutely need to work, you need to get down over here, which is usually where that happens, and you're prepared because you have taken yourself out of a lot of the risky investments, then this is a perfect place to be. So I think that that's really important to understand that it's an emotional game, right? When you're investing, okay? So I'm gonna go ahead and stop sharing. Now, next thing is, how do you prepare for investing during a recession? Because it's really easy to say right now, like, how do you prepare? And it's easy to look back and say, oh boy, like, I wish I had saved some more money, because now things are starting to drop off, or things are getting more pricey, or wherever we think we are in that timeline going up and down. So I think that, as I touched on before, keeping a diverse set of assets is going to be really important. And I really think real estate should be a key component of every single person's portfolio. Whether you're living in a house or you have rental properties, I think it really is a cornerstone investment because of so much of the advantages that you can get from it. And we'll even get into more of that a little bit later on. And like I said, do not try to time the market, because now you're playing risk with two things. You're trying to predict when it's going to be at top, and then you're going to try to predict when the bottom comes down. And so that's really hard. Like, it's really hard to even predict while we're in an up market when it's going to stop, because things go up and down, and they trend up, and then they start dropping down real fast, or vice versa. And so it's just really hard for us to see that in day to day. Humans don't do too well with that. So I just think that having an overall strategy where you're consistently investing and having good criteria to deploy your capital into in a conservative way, where you're still able to sustain yourself and your family, but then also be well diversified and well thought out, that's going to lead you to the most success, okay? And then also another tip is, make sure that you have like a cash flow plan or a budget at home, so that you set aside some money that you can gamble. I use the word gambling loosely, but really what I mean is investing or speculating, right? And so if you have that set aside amount that maybe you and your spouse have already negotiated, or you've already talked through and said, yeah, we're comfortable setting aside $5,000 to just, if we lose it, then, okay, lessons learned. Hopefully we learn something from that, but it's not the end of the world. And so I encourage you to figure out what that number is and try to save that amount up right now while things are still relatively good. And we're kind of seeing some market changes starting to happen right now, because I think that we may be kind of heading towards either an up or a downward slope. I don't know where that is exactly, but it's always good to at least put some of that stuff aside. So I would encourage you to do that for sure. Before I get into the next thing, I wanted to talk a little bit too about what might be different this time, right? So we talked about how recessions are emotional, and those who are able to take the emotion out of it and execute a plan are going to win. And then we talked about some ways or some action steps that you could take on to also get yourself into that mode, so that you're actually executing a plan, right? So those are the two steps. And the third thing is, what might be different this time? Okay, so last time, there's always some sort of thing where a bubble comes and then it pops, right? And there's always something that causes it. And the last time it happened in 2008, it was real estate that caused that. And actually behind that, it was the mortgage-backed securities. And if you want to learn more about that, there's a movie called The Big Short, which is a really great movie on how all of this works. And so they go into more detail and they give you personalities and tell stories. And so it's a really, really cool thing to watch. But what I wanted to kind of extract from is that that was caused by real estate that was also combined with Wall Street instruments where people were betting on other things. And so we had these risky mortgages that were being used as financial instruments, as chips on a table, on a poker table. And then, they expected the insurance or the rising home prices to take over. And eventually people caught on, and the whole financial system kind of collapsed one after another, and the insurance companies couldn't pay all that up. So where did the money come from to make up for all those losses? And so that's what kind of caused the collapse. This time, I think things are a little bit different because at least in a real estate point of view, the COVID situation has really accelerated some sort of economic strain in the system. We're seeing it now in retail and people that work in brick and mortar places where now there's physical restrictions. You just can't work there. And so because those restrictions are in place, you're losing those types of business. But real estate as its fundamental mechanical investment is pretty sound on the residential and on the industrial side right now, because there's a lot of demand for people to have bigger space and work in bigger homes and things like that. So there's a lot of real estate everywhere and population is increasing. So I personally think that real estate is still going to be in demand as long as population is increasing in the US. It's just a matter of where it's going to be. Is it going to be in California, or is it going to be in the Midwest, or is it going to be in the Southeast? You just have to understand like where people are moving. And so I really think that it's important to understand that depending on what the market is and what's causing it, you can really use that understanding to help you understand what investments are a little bit safer perhaps than the other one. And it's not guaranteed because you never know what's going to cause it. It could be housing again that causes the next bubble to burst. We just don't know what that is. But I would say that it's very unlikely that that's going to happen. I may be eating my words here eventually if someone's watching this, a couple of years in the future, a couple months in the future, who knows. But my personal opinion is that assets are a great place if especially you don't have trust in the currency. And I'll be honest right now, the federal government is printing off tons and tons of cash right now. I know we have the world reserve currency status, but being in this economy right now where we're just be able to print as much money as we can, if we're able to take our cash, right, and convert it into assets that have debt behind them that's being paid for by other people or being paid for by itself as the investment, then that debt is fixed, and then the dollars printed are going to go up like crazy. So the value of that property is still the same in the economy, but with the more dollars in the economy, the value is going to go up, but the debt's going to stay fixed. So real estate has a really unique position to where if you borrow money against something that you can have the tenants or the asset pay for the debt behind it in any situation, especially right now in COVID when people need a place to live, that's always going to do well because the debt stays fixed, but the income and the income and the appreciation on the property or the value of the property are always it's going to increase if there's inflation, right? The other alternative is deflation. And I won't get into that, but that would be really bad. It wouldn't be real estate that suffers only, but it would mean that the dollar becomes too strong. And so the debt out there becomes even more expensive. And then that's kind of a situation that our market can't really tolerate right now at this point. And, at this point, let me just show you a few more graphics here that I thought was really, really interesting. So I'm going to share my screen once more. And let's see. Oh, it doesn't look like it's allowing me to. Okay, share screen. This guy. All right. So this is the chart that we looked at before. And then this next one, let's see if it goes. Not moving. Okay, let me pull up the next one for you. I just want to make sure you guys see this because it was pretty cool to me. All right, and so here we go. So how debt works, right, is this is taken from Ray Dalio, right? Over a general economy, generally grows because of people are more productive. And then there's two types of debt cycles. There's a short-term and then a long-term one. And usually this long-term one means that it kind of corresponds with the growth of empires. Like before the United States, there was the Great Britain. And then before Great Britain, there was the Netherlands, right? And so these economies controlled the world economy. They were the ones that everyone trusted. So people invested in that currency and they kind of followed that along. And along the way, there were ups and downs, right? Like people borrow money and then they can't pay it back. And so the economy crashes, people foreclose, and then it goes up and down, right? There's a long-term debt cycle where, economies start shifting fundamentally, the understanding of it. And maybe we're at that right now with Bitcoin or some of these these countries like China challenging the United States in terms of economic power and reliability. And so we may be at a point right now where a long-term debt cycle could really shift the dynamics of everything we know about the economy. And so you have to be aware of these three factors, right? These types of forces. And Ray Dalio has a fantastic video on how this all works. It's called How the Economic Machine Works by Ray Dalio. And it's a super cool video. It's like 20 minutes long. And basically that was more useful to me than all of my years of economics in school. It was just such a great video. Really well done by a very smart man. So I would say that that's something you could look at there. And then the other thing that I want to show you is not Spotify, but I wanted to show you America's debt right now. So this is debt, right? You can see that the GDP, this is the gross domestic output. This is how much money the economy makes and creates. And this is the debt behind it. And as soon as the money started to cross a threshold, I thought that was a really bad thing, that we have more debt than spending in the economy, which really tells me that there's something's going to happen. And so the only way that we're able to make this happen, because we have to pay interest on our debt, but if we're not making enough money as a country to even pay the bills or the interest on the debt, what do we do? And so, of course, what we do is we print more money, and then that leads into people not trusting the dollar anymore. And so things could go down really hard if they find that, the Chinese economy might be better to bet on or something, right? So COVID-19 has just kind of exacerbated that. And what I'm saying is that we're more likely to see an inflationary economy than we are deflationary. And if it's going to be an inflationary economy, then diversifying yourself into real estate or some other asset class like stocks or companies or even like commodities at this point, to get your storehouse of wealth out of US dollars and into something else, that's going to do well for you. But if you can partner with all of these forces going on and you understand what's happening in a recession, then you can really do well, because if you understand what's happening early, you can position yourself so that while everyone else is really not understanding what's happening, and so they're not taking advantage, or they're not understanding why things are just exploding. If you say, okay, well, it's really just because we're printing a lot of money, I just need to take my money out of cash and put it into something else that will do good and that partners with inflation, which would be real estate. You can borrow money at a fixed rate, and then the values continue to go up, or the value stays the same, but the dollars get worth less. So the value's still there, the dollars get worth less. You get to see that translate to an increase in value on your property while the debt stays the same. So I think that that's really important to understand as to why, why we're in a recession. And that's really important, okay? So I will stop sharing the screen. And now it's back to us. And I just wanted to finally kind of wrap up here, because I know this is a long stream. It's pretty heavy on material. But for those of you who are looking to invest in real estate in a recession, let's say that you have a plan together and you've got $50K or $25,000 that you're looking to invest at any time right now. You're just looking for opportunities. I do have some advice for you. The first thing that I would do is I would say that investing in real estate anytime makes sense, especially if you're buying in the right manner and you're buying with the right fundamentals. I would make sure that you understand what your risk tolerance is and what your exit timeline is going to be. So if you like to be a little bit risky and try to get more return, then you can make a lot of money, but you can also lose a lot. So it's a lot like stocks. Where do you fall on that spectrum? Do you want to just buy the index, or do you want to buy just straight cash like money market? or do you want to do something else? Do you want to go into penny stocks right now at this point? So you have to understand like where your risk return is and what that timeline is, like when you want to get out. And so you're the only one that knows what's right for you. But keeping that in mind while you're looking for criteria in buying real estate is very important, okay? Looking for affordable markets, that's going to be another thing. If you're going to be looking to buy an expensive market where people are leaving in droves, especially with this whole COVID dynamic, right? Where, people are wanting to live out of their studio apartments in San Francisco and move into a 3-bedroom house in, out in the East Bay, here in the Bay, California area, it's like the suburbs. So people are moving out to get more space because they know they're going to be home a lot and the rates are really low. The interest rates are low. So like, why not do it, for the same price? Like, just why not get some more space and better quality of life? So I would try to follow that trend a little bit because I think it's going to be here to stay for a little bit longer, especially because of the work from home situation that a lot of workers are going to be in. They're going to want all that space. They're going to look for the Zoom rooms. They're going to want that extra bedroom in their house. And so I would really follow that dynamic. I would make sure that wherever you buy, it's an affordable place so that A, it's easy for you to afford to buy it as a rental or as a personal residence. And so you're not overstretching yourself. And B, wherever you're going, keep in mind that most people want to follow you, unless you have, unless you've got some weird priorities, right? But that's for you to decide. So I also would say that don't be in a hurry to buy as well, because odds are there's going to be another deal out there. And so just make sure that you're patient, you vet through your criteria carefully, and you kind of watch what's happening, because prices could continue to go up, but they may go down too. And, I think that buying right is going to be so much better for you than trying to than having FOMO, basically just buying the first thing that you see. So really having a clear set criteria and just watching the market, being a student of what's happening, is going to always help you no matter what. And that's why another Warren Buffett quote says that education is the best investment because it never ever goes down in value. It never goes down in value. And there's so much information out there that you can get it for free. So I encourage you to do that. Okay. And then the very last thing I'm going to say is do not just shut down, throw your hands up and walk away and be dejected and just kind of say, oh, well, this is too hard, or, I don't have the time for this, or I don't understand this at all. Don't do that. Reach out, try to find someone who's done it before and ask them questions. It all starts with curiosity, because no one's going to change your life except for you. You have to be the one that says, okay, what can I do to change my situation? Or how can I position myself to be able to take advantage of this market, and reach out to someone that already has done that, right? Or at least that's someone that's a couple steps ahead of you. And then once maybe you pass them up in knowledge, then you ask them who they know, right? And just continue to be educated, because this is all what we're doing here as a human race, is we're trying to learn and do the best that we can together, okay? So, felt like I've been rambling for a long time, and I'm looking at the counter and it is 23 minutes straight. So thank you guys so much for listening. I hope this was useful to you. And as always, just like and comment anything that you see here, and tell me whether or not you like the content, or you want to hear something else from me. I want to understand my audience in a much more close way. And so just please tell me what it is that you want to see more of, and we can work in that angle. So thank you guys for tuning in. I really appreciate it. It's always fun to be here with you on a Saturday, and I hope you guys enjoy the rest of your weekend, and we will catch you next week. Take care, guys.